Assalamualaikum warahmatullahi wabarakatuh and good morning. We are from Goto, which are Muhammad Al-Hakim, which is me, Umarul Aiman and Muhammad Fadil will talk about chapter 6, which is technical analysis. Okay, firstly the introduction. What is efficient market? Efficient market is a market in which securities reflects all possible information about securities quickly and accurately based on the stock market. Then, efficient market practices. It relates to the markets have a large number of knowledgeable investors who react quickly to new information, causing securities price to adjust quickly and accurately. There are three levels of efficient markets. Firstly, weak form. Past data on stock prices are no use in predicting future stock price changes. Everything is random in this form. It should simply use term a buy and hold strategy. According to weak form efficiency, technical analysis cannot predict future movement because all past information has been already accounted for, and therefore analyzing the stock past price movement will insight into its future movement. Second, semi-strong form. Abnormally large profit cannot be consistent earned using public information. Any price abnormalities are quickly found out and the stock market adjusts the price. Lastly, the strong form. There is no information, or public or private, that allows investors to consistently earn abnormally high returns. It states that all information in the market is accounted for in a stock price and neither technical nor fundamental in each. Okay, next, the random walk. Random walk theory suggests that changes in stock prices have the same distribution and are independent of each other. Therefore, it assumes the past movement or trend of a stock price or market cannot be used to predict its future movement. In short, random walk theory proclaims that stocks take a random and unpredictable path that makes all methods of predicting stock prices futile in the long run. There is no way to know where prices are headed. Studies of stock price movement indicate that they do not move in neat patterns. This could be an indication that markets are highly efficient and respond quickly to current situation to give the move or the indication of the new price.
Next, I will explain about the Dow theory. Dow theory is created more than 100 years ago by Charles H. Dow. It is based on the idea that market performance is based upon primary trend in overall market. Ignore secondary movement and is used to signal an or bull of bear market. There are 6 main components in the Dow theory, that is market discounted everything. There are 3 primary trends. Primary trend has 3 phases. Index must confirm each other. Volume must confirm trend. Trend persists until a clear reversal occurs. Next, what is trend? Trend is the general direction where the market is going. It can be uptrend, downtrend, or sideways. In the theory, here are the 3 primary trends in the market. Market go through primary trend that are a long-term trend, and secondary trend that are intermediate trend occurs inside this bigger trend, frequently working against the dominant trend, such as a pullback within a bull market or a rally within a bear market. Finally, there are minor trend patterns that are mostly noise and short-term. Next, index must confirm each other. For a trend to be established, the projected index or market average must confirm each other. This means that the signal that occurs on one index must match or correspond with the signal on the other. If one index is confirming a new primary uptrend, but another index remains a primary downtrend, traders should not assume that a new trend has begun because the index is not confirming each other. Next, I will explain about the confidence index. The confidence index compares high-grade corporate bonds against low-grade corporate bonds. based on the theory that market trend is usually appears in bond market before the stock market. This is because when interest is high, people will buy more bond to make more return, so people will run from stock market to bond market. That will make the stock market fall and vice versa. Next, I will explain about the several indicators that determine whether the market is strong or not. First is market volume. It is a pure supply and demand analysis for common stock. The higher the volume, the more active the security. Volume is the total numbers of shares traded during a given period. Normally, it is shown in the bar found at the bottom of the stock chart. Volume can be used to determine the strength of a trend or confirm the movement of the price. Strong market happen when volume go up and weak market happen when the volume goes down. The second is breadth of the market. Breadth of the market is a dynamic analysis theory that predicts trend of market according to the number of advance or decline trading day. If the breadth indicator is strong, this is theory predict that the market will rise and vice versa. Strong market will happen when advance is more than decline, and weak market happen when decline are more than advance. Next is contrary opinion. Contrary opinion measure the market sentiment and predict the market trend. Contrary opinion is the opposite opinion of sentiment held by majority. It is based on the idea that when vast majority of people are agree on anything, they are usually wrong. Small traders are believed to be wrong in the market timing, so it is assumed that small traders will do just the opposite of what should be done, and they will panic and sell when market is low. They speculate and buy when the market is high. Therefore, if small investors are selling their share, it is a good time to buy the share.
Following that, we will discuss the tool used in technical analysis, specifically charting. As we all know, there are 4 types of chart that most people use, including line chart, bar chart, point and figure chart, and formation chart. Allow me to define these 4 charts. First, line chart. Line chart is a graphical representation of an asset historical price action that connects a series of data points with a continuous line. This is the most basic type of chart used in finance. Line charts are used to track changes over short and long period of time. When smaller changes exist, line charts are better to use than bar graph. Line graph can also be used to compare changes over the same period of time for more than one group. Secondly, bar chart. Bar chart consists of multiple price bar, with each bar illustrating how the price of an asset or security move over a specific time period. Each bar typically shows open, high, low, and closing prices, although this might be adjusted to show only the high, low, and close price. Bar graphs are used to compare things between different groups or to track changes over time. However, when trying to measure change over time, bar graphs are best when the changes are larger. Next, point and figure chart. Point and figure chart plot price movement for stocks, bonds, commodities, or future without taking into the consideration the passage of time. While sometimes considered an archaic form of charting price movement, and point and figure chart can be incredibly useful. If nothing else, point and figure chart provide a different point of view for analysis, which can be compared to indication gleaned from candlestick or bar graph. Lastly, formation chart. A chart formation is a pattern in the price data or other metric that a technical trader recognizes and can thus anticipate what the price may do next, based on how that pattern has played out when it appeared on prior occasions. Chart formation are used in the practice of technical analysis, whereby traders attempt to predict future movement in a security's price by studying the past changes in price and volume. There are many common types of chart formation or chart patterns that traders use in order to predict future price changes. Some widely followed chart information include the double top and bottom, head and shoulder top and bottom, rising wedges, triangles, price channel, and cup with handle. Now we will discuss support and resistance. Support or support level refers to the price level that an asset does not fall below for a period of time. An asset support level is created by buyers entering the market whenever the asset dips to a lower price. In technical analysis, the simple support level can be charted by drawing a line along the lowest low for the time period being considered, and the support line can be flat or slanted up or down with an overall price trend. Other technical indicators and charting techniques can be used to identify more advanced version of support. Support level is the level at which buyers tend to purchase or enter into a stock. and it refers to the stock share price that a company rarely goes below. Resistant or resistant levels is the price at which the price of an asset meets pressure on its way up by the emergence of a growing number of sellers who wish to sell at that price. And resistance level can be short-lived if the new information comes to the light that changes the overall market's attitude towards the assets, or they can be long-lasting. In terms of technical analysis, the simple resistance can be charted by a drawing along the highest height for the time period being considered, and resistance can be contrasted with a support.